Good morning or afternoon, wherever you may be, to everyone who's watching. Thank you so much for joining us at another session of the Metals Investor Forum, the pre-PDAC version of the Metals Investor Forum. Certainly strange to be doing this from home, but we're getting used to strange times. So onwards and upwards. Very happy to be here with a good group of companies that I'm excited to introduce to you. But of course, first I will yammer away for a while about what I'm seeing going on out there. As usual, please send in questions while I'm talking and while the folks in my session are talking. If you have questions for any of us, we would love to get them in, and I will convey those questions at the end of the session when we do a Q&A. So you can see the title of my talk here is Metals Bull Market Dead Ahead, but gold's going to need a little bit of patience. And you can just look at metals charts right now to realize that that's not sort of an overly dramatic statement. We've been seeing some very strong performance in base metals for good reason, and gold has, lost something like 17% since its high last August. So I'm going to go through what I think is happening there, what I am doing about it right now versus in the sort of more medium term, and why I'm doing all of those things. Okay, so the first part of the talk headline was metals bull market right straight ahead. Why am I so confident in making that statement? Well, broadly speaking, I think there's four things that metals need for a bull market to exist. We need strong demand, ideally against weak supply. It is certainly helpful if the US dollar is not strong. A strong US dollar creates a headwind for a metals bull market, and so a weak US dollar is helpful. Negative real rates are the thing that we need for gold. We also need investors to care about real rates, which is a sort of a slight angle on that I'll get into in a moment here. And we need a reason for investors to be interested in metals, because there's lots of things out there if you're an investor that you can put your money into. So what is the thing that might pull their interest towards this space? I think that all of these are met right now. I think we have all of these conditions met to various degrees. Now, I put this slide together later last week. So these headlines are a few days old, which is why they are not about copper losing a bunch in the last few days or nickel falling through the floor. But nonetheless, these capture the sentiment that we've been seeing out there around copper and around gold. So let me go through each of those in a little bit more detail, not deeply, but a little bit more depth. The first thing that we need is strong demand for metals, ideally against weak supply. Now, that in itself could be a very long talk, but the big picture here is that all the stimulus that's out there, all the infrastructure programs that have been announced and are expected, and including what we are expecting is a large stimulus program from the United States, recovery in general, these things need metal. These things need copper, need nickel, need zinc, need iron ore. And so that is why base metals have been going nuts. You can see here the 6-month charts for copper, iron ore, and nickel. You will note that nickel took a bit of a nosedive in the last few days. That's because of a new source of supply that came online. Well, it's partly a correction from a massive ramp up. And then there was news about a new source of supply that came online that has eased the supply constraints situation there. It's rebounding a bit today. These things stabilize and bounce around. That really just fits with the second point that I have here. There will be bumps on the road to reality, like we've seen for these last few days with copper and with nickel. But the massive stimulus that's out there to support global economic growth and recovery straight up means demand for metal. And so that's the situation that we're in. I think there's added emphasis within that on green technology and green energy, which adds to the bullish setup for green metals. Most of them are green, to be honest, but in particular, I'm looking there at copper, silver, and nickel. And the supply scenario is pretty tight for all of them. Again, that's sort of a broad statement that requires a lot of backup. And I don't have time to go into all of the supply pictures for the various metals, but they're pretty tight. Some of them are already in deficit. Some of them are looking ahead at deficit. And that's no surprise after underinvestment in mine exploration and development for a decade. The second point on my what do we need for a bull market in metals list was a weak US dollar. We've certainly we've been in a strong US dollar paradigm for a decade, and I think there is certainly reason to believe that that bull run is ending. Is this a double top right now? It certainly is looking that way. Why would that be happening? Well, inflation. I mean, that's a huge topic of conversation and one that I will touch on a little bit more as we go through here. There's China's very long game to reduce its reliance on the US dollar. Like I say, super long game. There's no fireworks from that now or tomorrow, next week, but it's absolutely something that is underway. And then there's just the basic reality of immense debt loads, both government and corporate. Now, the United States is not unique in this. Countries around the world are facing these same situations, but currency valuations are always relative, and the US debt scenario is particularly bad amongst the group. So I do think that the takeaway here, I'm not expecting the US dollar to fall off a cliff by any means, but I do not think that a strong US dollar is going to provide a huge headwind for the metals bull market. So that's helpful. Then we have gold. Now, negative real interest rates are the most important bull force for gold. And we are in that setup right now, undoubtedly. This is the inflation index 10-year treasury. So it's like the real yield on the 10-year, so corrected for inflation. And over the last 7 years or so, you can see that, you know, we've gone through an up and down here as this slow plow horse gold bull market has been underway. But through 2019, falling real rates helped get gold going again. And then suddenly COVID hit and bam, real rates were slammed into negative territory, and they are set to stay there or go lower for years. And why am I so confident in saying that? Well, the Federal Reserve keeps telling us that they're not going to raise rates. Like they say it every time one of them gets up on a stage. I mean, some of them are always a little bit more hawkish, sort of fundamentally, but their overall setup is very clear. They are far from their goals of, in terms of unemployment and in terms of core inflation. And they have even said that they will let inflation run farther than usual to get to an average of 2% as opposed to just getting to 2%. That's a big difference. It's going to have to be well above 2% for quite a while before the average comes to 2. And so there's no reason to believe that interest rates are going to go up anytime soon. And therefore, as inflation starts to play a role, real rates get more negative, and that's what matters for gold. The chart on the bottom here is what I call correlation. It's gold inverted against the same thing, the US 10-year real yield, and they track each other like they're best friends. The thing is, right now, we do have negative real rates, and yet gold is not doing what we want it to. So what is going on right now? My take on the current setup is that inflation uncertainty, there's a lot of uncertainty about exactly when and how quickly inflation will really show up. Now, inflation is a complicated subject. Depends which inflation measures you use, official inflation measures or more private measures of inflation that are almost always far higher than the official measures. Nonetheless, we're in unprecedented territory in terms of the amount of money that's being printed and spent, and how that money is being distributed in the economy and in the financial system. It all leads to a lot of uncertainty as to exactly how inflation is going to show up. And because the way that you calculate real yields is by taking the nominal yield, the one that's out there for the 10-year or whatever, and subtracting inflation, if you don't know exactly what to subtract for inflation, it's a tough equation to do. You're missing one of the components. And so I think that's the reason why nominal rates have been grabbing all the attention lately. And nominal rates have been going higher. Now, why have they been going higher? I think money is rotating out of bonds because of this fear of inflation, and because there's yet another flood of treasuries, of issuances coming, starting with the $1.9 trillion stimulus package, plus who knows how much for an infrastructure package that's expected. There is a real oversupply of bonds right now. When bond prices fall, yields rise. So that money is rotating out of bonds because of a fear of inflation, which erodes bonds, and because there's so much supply of bonds. And it's rotating into stocks because we're looking ahead towards an economic recovery, and that's the kind of premise that puts you into stocks. So that is pushing nominal yields higher. And of course, higher rates, higher yields are gold negative. That's what the chart on the bottom here shows. This is from Incrementum, and it gives you the 10-year bond yield inverted and the gold price. And you can see that they track very closely. If you add in gold seasonality, which is that gold is usually a bit weak from March through June, it's undeniable that we are in a period of near-term risk. So that's why I say, you know, you're going to have to be a little bit patient for gold to start participating in this metals bull market. I'll get back to the details of what to do about that in a moment. For now, I want to get to the fourth point on that first list that I gave of why I think that we're headed into a metals bull market, all the conditions. And the last one is that investors need a reason to be interested in metals. And are there reasons to be interested in metals? I think so. So there's the strong argument that we are looking at a bull market for base metals. I mean, all of the very sort of sensible factors are out there: growth, lack of supply, inflation coming. These are all the classic arguments for a base metals bull market. Then you have fundamentals for gold that make sense. Even if they're on pause for a few months now, they absolutely make sense. Then there's inflation as it manifests, which it will. There's uncertainty over when and how quickly, but it absolutely will. Though that pushes people to both gold and base metals. And there's stock market risks. I mean, I think that the main takeaway from the Reddit thing that happened with GameStop and all of those, it was a really good example of excesses, that there's a lot of speculative excess in the market right now. There are forces that are encouraging speculative excess, and that creates volatility. That just layers on risk. And so there's also a safe haven argument in rotating not just to gold, but to things that make financial sense, that have lots of clear value, and miners are in that setup. And then there's the fact that metals just like to run together because these things that drive them are all interrelated. And it adds up to metals and miners just make sense. You don't need to be a gold bug to believe that the metals and miners setup is attractive right now. The two quotes that I have here are just from one of the many emails that I get every day, that's arguing that's about investing. And I subscribe to all kinds of investing newsletters so that I can see, and not just metals and mining ones from across the board. This was from one that is not a metals and mining newsletter. But guess what their topic was? It was about how there's such an exciting opportunity evolving in the metals complex. And the chart of the Euphoria Index down here is just a little example of how we are in a situation of speculative excess. So those who are a little bit more cautious in the investing world will be looking for ways to diversify the exposure in their portfolio. How do you address those risks? How do you find things that make fundamental sense? Well, miners really step forward in that mix. They just make so much sense. This Incrementum chart here shows total debt to assets. I mean, miners are the best. Like, they literally are the best. Their balance sheets are the best out there. They stand out across equities for their balance sheets, for their free cash flows, and for their dividend yields. Scotiabank, and this was perhaps 2.5 months ago, 1.5 months ago that this number came out, but their average mid-tier and major gold miner dividend yield in their coverage universe was 2%. That's killing the S&P's 1.6% average. And importantly, miners' dividend yields are only going to get better. The chart on the right there shows how free cash flows are ramping up. And a bunch of the major miners out there, copper, Freeport has done it, Newmont has done it. So on the base metal side, on the gold side, they have specifically pegged their dividends to their incremental free cash flow. So as those cash flows ramp, their dividends are going to ramp. Newmont's already at 3%, for crying out loud. That's a fantastic dividend yield. And so miners just make a lot of sense. Okay. All of that big picture stuff leads us to, okay, well, what do you do right now? And the fact of the matter is that timing is always everything, right? Short term, and the crux of that is that short-term predictions are the hardest ones to make, but they're still important because you always want to enter on an interim dip rather than a peak. And when you play in a speculative high-risk arena like junior miners, it's always important to manage your risk, to sell some into strength and buy more during weakness. That is key to success in the junior mining space. I mentioned that there is near-term risk ahead for gold, and this is a seasonality chart for gold, and it just sort of hammers that point home a little bit. From March through July, you know, it's not that exciting in the gold space. The exciting months are January, February, and the fall. So that just underlines that right now might not be the best moment to enter gold stocks. Now, there's caveats for that on the very junior side. So wait till the next slide so I can get to those caveats. But this chart with all of its colors, red are the things that I think are least likely to happen. Green are the things that I think are most likely to happen. Yellow right in between. So what's going to happen for the next 6 months? I think base metals, industrial precious metals, so that's everything but gold, and green energy metals. I mean, I really think that the market focus on lack of supply and supply disruptions are going to send those metals higher from now. I don't think that there's a near-term risk in particular for those. There will be bumps on the road, like I said, but I think they're set up, they're going, it's happening. As for gold and silver, depending which bucket you put silver in, I think gold is more likely to follow the pattern and slide for the next few months. We're seeing that right now. So like I say, I'm not super prescient. I'm sort of just telling you what is happening because that's what seasonality says. That's what these uncertainties about inflation suggest. And this pegging to nominal yields instead of real yields, that's just what's happening. Because of this, I mean, a month ago, I encouraged readers to sell enough in their portfolios to cover their tax bill, to make their RSP contribution, to not stress over the next few months if their gold stocks step back. I think that's very important. You know, your mental health matters. And to have cash to deploy into seasonal exploration opportunities, summer doldrums, and to ensure that you buy enough base metal exposure to take advantage of the right side of that chart. Now, I said that there was a caveat for juniors, and it's a very important one, which is that companies that are building mines or already mining, they follow price patterns, right? So a gold miner will follow gold seasonalities. Discoveries, however, happen when they happen, and stocks respond when the discoveries happen. They don't follow patterns. So on the explorer side, you need to buy stocks based on their schedule, based on what each company is doing, when their results are coming out, when they are going to start marketing, you know, getting permits, drills turning, whatever it might be. There are a lot of forces that push junior share prices around: financing needs, free trade dates, when they can explore their projects, all of these sorts of things. And of course, what results they get. So you just need to pay attention to each story and position relative to those forces for that story. I know that's an annoying thing to say because it's a lot to dive into and research and understand for each stock, but that's unfortunately what you do have to do for these higher risk speculative stories. And within that, one of the forces that's sort of pertinent right now is that the explorers who can only work in that really short summer season, they almost always start to ramp up. Their share prices start to ramp up, not when results are about to happen, because that's not until like August at the earliest, September, but in anticipation. So the share prices, for example, of companies exploring in BC's Golden Triangle usually start to rise in May, June, as the companies get out to start talking about what they're going to do in the coming season, get people excited about that. So that's a factor to pay attention to as the months get warmer. As a general statement, if you're assessing junior explorers, especially pre-discovery ones, the short version of the list of things that you need to demand from these stocks is really make sure that there's multiple chances for success. If there's just one target, the odds are not in your favor if they only have one target. They need to have a clear plan. And that covers a lot of bases there. They need to have a clear exploration plan. They need to have a clear geologic theory. They need to have a clear plan for when they're raising money, how they're raising money, where that money might come from, what they're going to do with that money in order to create value so that hopefully the next raise can happen at a higher level. These things are multi-layered and complicated, but there needs to be a clear plan to create value. This isn't a science experiment. This is about boosting share prices. And a successful clear plan really relies on both technical and capital markets expertise. They need to have both of those covered or the stock just won't work. I covered a lot of ground in that. So if there are questions, certainly please send them in. I will try to answer a few in the Q&A. And or you can always send them to me to my email. I do answer all of the subscriber, or not even subscriber, all of the questions that come into my inbox. Maybe not like immediately, might take a few days, but I do answer them all.